Hello, this is Jeremy North with your educational and economic update for February of 2022. Well, in this month's video, I will discuss major headlines that influence markets in January and economic and market events that we are looking at to influence February returns and going forward. As always, please stay tuned at the end of the video for the required disclosure statement. After a banner year for stocks in 2021, the market saw the worst performance since 2008 and 2009 bear market in January. The S&P 500 finished January down 5.3%. It was the index's worst January since 2009. The tech-heavy NASDAQ composite lost 9%, its worst month since 2008. It is now down more than 12% from its November peak. Bonds were also down, with the Ag Bond Index losing over 2% in January. The sell-off was caused by the Federal Reserve and other of the world's central banks declaring that they will increase interest rates to fight inflation. While the Fed is partially to blame, the other big culprit is inflation. COVID-19 led to the government and business shutdowns around the world. As government stimulus programs kicked in to help with the temporarily unemployed, demand for goods skyrocketed. The supply chain slowed to a crawl as it lost workers and experienced shutdowns that it still hasn't recovered from. Unable to meet demand, prices soared across all facets of the economy. With this increase in inflation comes the more aggressive stance from the Fed on increasing interest rates. This has hit the tech stocks hard, as any increase in rates lowers their earnings potential. However, this is not all bad. Most company reporting earnings so far have beaten estimates. Fourth quarter revenue in 2021, the growth has averaged 16% and net income growth is at 25%. Demand for goods across the economic spectrum is still very robust. Some, like Apple, had their best quarter ever. Even with prices increasing, demand remains strong. COVID impacts on the economy appear to be easing. Among others, both McDonald's and Southwest Airlines have made great progress in meeting all staffing demands. COVID greatly affects the service sector, but the ISM non-manufacturing index showed growth once again. This is the 20th straight month of service sector growth. COVID Omicron cases have peaked and are coming down rapidly. Death rates are generally lagging, and this is again the case as the death rates are hitting new highs currently. This too is expected to begin dropping over the next couple of weeks. We continue to believe the impact of COVID will subside as long as another easily transmitted strain does not surface. With all this conflicting data, the markets have become extremely volatile due to the stock market being highly vulnerable to price changes in those big top 5 stocks, which are Apple, Google, Meta, which was Facebook, Microsoft, and Amazon. Together, they are 42% of the NASDAQ 100 index and roughly 22.5% of the S&P 500 index. Overall, we expect to continue seeing high volatility in the market due to those mixed signals that investors are getting. The negative signals include the Fed's stance on raising interest rates, inflation, of course, Omicron, supply chain problems, and slowing GDP growth, plus Russia's massing at the Ukraine border. Positive signals include mostly strong earnings growth and positive economic outlook driven by consumer demand. We will remain cautious in our outlook with the increased uncertainties we talked about. If you have any questions about how the market volatility can impact your long-term goals, we are here to talk. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call at 636-896-4052. With all that being said, here's the disclosure I am required to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or a solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decision. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested to directly. Past performance does not guarantee future results. This is Jeremy North. Thanks again. Have a great rest of your February of 2020. If I don't know where you are in the nation, but if you're anywhere in the Midwest, I know we're getting pounded with snow. So hopefully the weather wherever you are is better than ours. Take care. See you next month. Bye-bye.